Tesla just posted its worst quarter in years. Revenue missed, profits plunged, deliveries fell short, and yet the company is promising a massive turnaround in the second half of 2025. The question is, can they pull it off? In this video, we're diving deep into Tesla's Q1 2025 earnings, breaking down what went wrong, what the company is promising next, and whether long-term investors should believe the hype or brace for more downside. Let's get into it. Let's start with the headline numbers. Tesla reported Q1 revenue of $19.3 billion. That's a 9% drop from the same quarter last year and well below Wall Street expectations of $21.45 billion. Net income came in at just $409 million, down a staggering 71% from a year ago. Earnings per share came in at 12 cents GAAP, 27 non-GAAP. Both missed analyst estimates by a wide margin. Vehicle deliveries, one of Tesla's most closely watched KPIs, fell to 336,000, down 13% year over year. Production also slipped to 362,000 vehicles, off 16%. This was Tesla's first year-over-year decline in deliveries since the COVID shutdowns of 2020. So what caused the slump? The reasons are layered. First, production disruptions hit the Model Y line, particularly in the Texas Gigafactory, where upgrades temporarily slowed output. Second, Tesla is feeling the heat from intensifying global competition, especially from Chinese EV leaders like BYD and NIO, and established players like Hyundai and Volkswagen pushing hard into electric. But the biggest wildcard might be Elon Musk himself. His high-profile role with Trump administration Department of Government Efficiency, known as DOGE, also sparked protests, brand boycotts, and even vandalism of Tesla showrooms across parts of Europe and China. Tesla's brand, once a symbol of innovation and environmental progress, is now facing political backlash, and that's hitting demand overseas. Now let's break down the revenue by segment. Tesla's core automotive revenue is $13.9 billion, down nearly 20% year over year. This includes vehicle sales, leasing, and regulatory credits. Lower deliveries, price cuts, and weak overseas demand all contributed to that drop. Energy generation and storage, often overlooked, was a bright spot. Revenue surged 67% to $2.7 billion. Storage deployments hit 10 gigawatt hours, a 154% increase year over year, thanks to growing megapack installations. Services and other revenue, which includes vehicle servicing, used vehicle sales, supercharging, and insurance, also came in at $2.7 billion. That segment saw modest growth and provided some margin stability in an otherwise challenging quarter. Gross margins, though, continue to shrink, falling to 17.4%, down from over 19% last quarter and 21% a year ago. Tesla's aggressive price cutting and underutilized factory capacities are taking a toll. Now, here's where things get interesting. Despite the rough quarter, Tesla isn't scaling back. It's doubling down. According to the earnings call and Musk's post-earnings remarks, Tesla plans to begin production of 2 new, more affordable electric vehicles by mid-2025. These models will be built on a next-generation platform produced on existing lines, which Musk says will help keep costs low and speed up the rollout. Then there's the Robotaxi. Tesla confirmed a pilot launch of the Cybercab, its long-anticipated autonomous vehicle service, beginning in June 2025, starting in Austin, Texas. Full-scale production could follow in 2026, pending regulatory approval. Elon Musk also reiterated his belief that Tesla's full self-driving technology is closer than people think to reaching level 4 autonomy. That would mean a vehicle capable of handling most driving tasks without human input, a leap that, if real, would transform the economics of both Tesla and the entire auto industry. And finally, Tesla expects energy storage deployments to continue booming. Management says the division could exceed 50 gigawatt hours for the full year, up from just 10 gigawatt hours in Q1. So just to recap, Tesla had a brutal quarter, deliveries are down, profits are down, sentiment is shaky, but the company isn't playing defense. It's leaning into a high-stakes growth plan built around new models, autonomy, and energy. The next question is, can Tesla deliver on all of this? Or are investors being asked to believe in another round of overly optimistic Musk promises? We'll dive into that right now, as we break down the feasibility of Tesla's guidance, the risks ahead, and whether the stock still makes sense for long-term investors. Let's begin with the new vehicle plans. Tesla says it will launch 2 affordable EVs by mid-year. These would be its cheapest vehicles yet, likely targeting the sub $30,000 range. But scaling a new model, even using existing lines, is no small feat. Historically, Tesla's been late on almost every production launch. Model Y, Cybertruck, even the Semi, all hit delays. So it's fair to ask, can they really hit this timeline in a softening market? And what about the Robotaxi? A pilot program in Austin sounds exciting, but the tech isn't there yet. Tesla's full self-driving system still requires frequent driver intervention, and US regulators haven't greenlit fully autonomous fleets. Launching a trial is one thing, scaling nationwide is much different. Even optimists admit true autonomy could be years away. Meanwhile, Tesla's bet on level 4 self-driving raises bigger questions. If they're wrong, or even just early, they risk sinking R&D into a product that doesn't pay off soon. Investors have heard Robotaxi since 2019. Trust is wearing thin. Then there's execution risk. Tesla is planning to launch new models, expand energy storage, and roll out a Robotaxi, all while dealing with declining margins, political backlash, and global competition. China's BYD just overtook Tesla in EV sales. Volkswagen is aggressively electrifying its lineup, and in the US, legacy automakers like Ford and GM are pricing aggressively. Tesla can't afford more missteps. Plus, there's the Musk factor. With his return as full-time CEO, investors hope for more focus, but Musk is still juggling ventures from SpaceX to XAI. Distractions could derail already tight timelines. On the energy side, things look more solid. Megapack demand is strong, storage deployments are rising fast. If there's one division that could beat expectations in 2025, it's this one. But even here, competition is building from the likes of CAT, LG, and Fluence. So where does that leave investors? Well, Tesla stock is down 40% year to date. That's reset some expectations, but it's still not cheap. Even after the drop, Tesla trades at a forward PE of around 50. That's high for a car maker, even one that also builds energy systems and AI tools. What you're really buying with Tesla is belief. Belief that autonomy is close, belief that new models launch on time, belief that Musk can stay focused and deliver. For long-term investors, the upside is definitely real, but so are the risks. If Tesla hits its targets, this could be the bottom. But if execution stumbles again, there's more pain ahead. So, worst quarter in years, boldest promises in years, Tesla is at a crossroads. Will it pull off the turnaround, or are we looking at more delays and disappointment? Let us know what you think in the comments. Is Tesla a buy, hold, or time to walk away? And don't forget, like, subscribe, and stay tuned. We'll be following Tesla's next moves every step of the way.